Rebecca, a 45-year-old marketing director, was planning for retirement when she encountered an advisor that would test her knowledge of legitimate financial planning and teach her valuable lessons about Ponzi scheme investment fraud. The advisor promised consistent 15% annual returns through exclusive investment opportunities not available to general investors. Rebecca had accumulated $180,000 in retirement savings and was seeking professional investment management to grow her nest egg during her final working years before retirement, making her interested in advisors who claimed superior investment performance. The advisor, Jonathan Mitchell from Elite Investment Management, contacted Rebecca after she inquired about financial planning services and immediately claimed access to exclusive investment opportunities that consistently outperformed market averages. Ms. Bradley, Elite Investment Management provides access to exclusive hedge fund strategies that have generated consistent 15% annual returns for our clients over the past 8 years, Mitchell said with apparent investment expertise and performance track record knowledge. These opportunities are only available to qualified investors working through registered investment advisors like our firm. Mitchell explained that the exclusive investments involved sophisticated trading strategies and private equity opportunities that were not accessible through traditional investment platforms and required minimum investments of $100,000 to participate in the high-return programs. Ms. Bradley, our exclusive investment strategies involve algorithmic trading and private equity opportunities that generate consistent returns regardless of market conditions. Mitchell continued with apparent sophisticated strategy knowledge and market-independent performance expertise. The minimum investment requirement ensures that we can provide personalized attention and access to the most profitable investment opportunities. Mitchell showed Rebecca official-looking performance statements showing consistent monthly returns and client testimonials praising the investment results and Mitchell's professional expertise in managing exclusive investment portfolios. Rebecca was impressed by the consistent performance, but wanted to verify Mitchell's credentials and the legitimacy of the investment opportunities before committing a large portion of her retirement savings. I want to verify your credentials and research these investment opportunities before investing, Rebecca explained to Mitchell. Can you provide your regulatory registration information and details about the specific investments and their risk factors? Mitchell became evasive when Rebecca requested regulatory information, claiming that exclusive investment strategies required confidentiality agreements and that detailed information was only available to committed investors who met minimum investment requirements. Ms. Bradley, our exclusive investment strategies involve proprietary methods that require investor confidentiality to maintain competitive advantages. Mitchell insisted with apparent proprietary strategy protection and confidentiality requirements. Detailed investment information is provided after initial investment and confidentiality agreement execution to protect our trading methods from competitor analysis. Mitchell also claimed that regulatory verification was complicated for exclusive investment advisors and that his performance record demonstrated legitimacy better than regulatory paperwork that most investors didn't understand. Rebecca felt pressured by Mitchell's confidentiality claims, but decided to research investment advisor requirements and verify Mitchell's credentials independently before investing retirement funds. Rebecca contacted the Securities and Exchange Commission to verify Mitchell's registration and learned that neither Jonathan Mitchell nor Elite Investment Management were registered as investment advisors, which was required for managing client investments. Rebecca also researched the investment performance claims and learned that consistent 15% returns regardless of market conditions were typical characteristics of Ponzi schemes rather than legitimate investment strategies. Rebecca realized that Mitchell was operating an unregistered investment advisor fraud and likely running a Ponzi scheme by promising impossible returns while lacking proper regulatory registration and transparency. Rebecca contacted Mitchell to inform him about the registration requirements, but Mitchell claimed that exclusive investment advisors operated under different regulations and that SEC registration wasn't necessary for private investment management. Rebecca reported the unregistered investment advisor fraud to the SEC, the Federal Trade Commission, and her state's securities regulatory agency. She learned that investment advisor fraud often targeted retirees with promises of exclusive opportunities and guaranteed high returns. The authorities explained that legitimate investment advisors must be properly registered and provide transparent information about investments, fees, and risks rather than claiming proprietary secrecy about investment methods. Rebecca worked with a properly registered investment advisor who provided transparent investment options and realistic return expectations while following established regulatory requirements for client protection. The experience taught Rebecca to verify investment advisor registration through official regulatory databases and to be suspicious of advisors claiming exclusive access to investments while avoiding regulatory transparency. Rebecca now educates other professionals about investment advisor fraud and emphasizes the importance of working only with properly registered advisors who provide transparent information about investments and follow established regulatory requirements. Thomas, a 52-year-old engineer, was managing his investment portfolio when he encountered an advisor that would test his understanding of legitimate investment strategies and teach him valuable lessons about affinity fraud targeting his professional community. The advisor claimed specialized expertise in managing investments for engineers and technology professionals. Thomas had substantial savings from his engineering career and was interested in investment management that understood the financial patterns and retirement needs of technology professionals, making him receptive to advisors claiming industry specialization. The advisor, David Sullivan from Tech Professional Wealth Management, contacted Thomas through his professional engineering association and claimed specialized expertise in managing investments for engineers and technology workers. Mr. Patterson, Tech Professional Wealth Management specializes exclusively in managing investments for engineers and technology professionals because we understand your unique financial patterns and retirement challenges, Sullivan said with apparent engineering industry knowledge and professional specialization expertise. Our investment strategies are specifically designed for the high-income, technical professional demographic. Sullivan explained that technology professionals had different investment needs than general investors, and that his firm's specialized approach had helped numerous engineers achieve superior investment performance through industry-focused strategies. Mr. Patterson, engineers and technology professionals have unique investment characteristics including high savings rates, stock option compensation, and technical understanding that requires specialized investment approaches. Sullivan continued with apparent professional demographic knowledge and specialized strategy expertise. Our firm exclusively serves technology professionals and has developed investment methods specifically designed for your professional community. Sullivan offered to manage Thomas's $320,000 investment portfolio through specialized strategies that had generated average returns of 18% annually for engineering clients and promised personalized attention focused on technology professional financial goals. Thomas was interested in specialized investment management but wanted to verify Sullivan's credentials and performance claims before transferring his investment portfolio to a new advisor claiming industry expertise. I want to verify your credentials and performance record with technology professionals, Thomas explained to Sullivan. Can you provide regulatory registration information and references from other engineers who have used your investment management services? Sullivan became evasive when Thomas requested verification, providing general information about his experience while avoiding specific credential details or verifiable client references that could confirm his claimed specialization in engineering investments. Mr. Patterson, investment advisor credentials are verified through our firm registration, and client confidentiality prevents us from providing specific references, Sullivan insisted with apparent confidentiality requirements and general credential claims. Our specialization in technology professional investments is demonstrated through our marketing focus and understanding of engineering industry financial patterns. Sullivan also claimed that his specialized investment strategies were only available to technology professionals and that delays in portfolio transfer could result in missing optimal investment timing for engineering-specific opportunities. Thomas felt pressured by Sullivan's timing claims but decided to research Sullivan's credentials and verify his claimed specialization before transferring investment management to an unverified advisor. Thomas contacted his state's securities regulatory agency to verify Sullivan's investment advisor registration and learned that David Sullivan was not registered as an investment advisor and was operating illegally by soliciting investment management clients. Thomas also discovered that Tech Professional Wealth Management was not a registered investment advisory firm, and that Sullivan had no legitimate authority to manage client investments or claim professional investment expertise. Thomas realized that Sullivan was operating an unregistered investment advisor fraud while using affinity marketing to target engineers and gain credibility through claimed professional specialization. Thomas contacted Sullivan to inform him about the registration requirements, but Sullivan claimed that specialized investment advisors operated under different regulations and that his engineering industry focus exempted him from standard registration requirements. Thomas reported the unregistered investment advisor fraud to his state's securities regulatory agency and warned his professional engineering association about Sullivan's fraudulent solicitation of engineers for investment management services. The authorities explained that all investment advisors must be properly registered regardless of their claimed specialization, and that affinity fraud often targeted professional communities by claiming industry expertise. Thomas maintained his investment portfolio with a properly registered advisor who provided legitimate investment management with transparent credentials and regulatory compliance rather than claiming unverifiable professional specialization. The experience taught Thomas to verify investment advisor registration independently and to be suspicious of advisors claiming professional community specialization while lacking proper regulatory credentials. Thomas now educates other engineers about affinity investment fraud and emphasizes the importance of verifying advisor credentials rather than trusting advisors who claim professional community expertise without proper registration. Sandra, a 38-year-old physician, was diversifying her investments when she encountered an advisor that would test her knowledge of legitimate investment products and teach her valuable lessons about promissory note fraud targeting high-income professionals. The advisor offered high-yield promissory notes from established companies as safe alternatives to volatile stock markets. Sandra had significant income from her medical practice and was seeking conservative investment alternatives that could provide steady returns without the volatility of stock market investments, making her interested in debt instruments that promise stability. The advisor, Michael Chun from Secure Investment Solutions, specialized in promissory notes and claimed to offer safe, high-yield debt investments from established companies that provided predictable returns for conservative investors. Dr. Rodriguez, promissory notes from established companies provide guaranteed returns of 8 to 12% annually with principal protection that stock market investments cannot offer, Chun said with apparent conservative investment expertise and principal protection knowledge. These debt instruments are backed by company assets and provide the safety and predictability that physicians need for secure wealth building. Chun explained that the promissory notes were issued by established manufacturing and real estate companies that used investor funds for business expansion and guaranteed repayment with interest through legally binding debt obligations. Dr. Rodriguez, our promissory notes are issued by established companies with proven business models and asset backing that ensures investor principal protection. Chun continued with apparent company analysis knowledge and asset security expertise. These companies use investor funds for profitable business expansion and guarantee repayment through formal debt agreements that provide legal protection for investors. Chun offered Sandra access to promissory notes with 10% annual returns and promised that her principal investment would be completely protected through company asset backing and legal debt obligations that provided superior safety compared to stock market volatility. Sandra was interested in conservative investments but wanted to research the issuing companies and verify the legal protections before investing in promissory notes that offered higher returns than traditional safe investments. I want to research the companies issuing these promissory notes before investing, Sandra explained to Chun. Can you provide detailed information about the companies, their financial statements, and the legal documentation for these debt obligations? Chun became evasive when Sandra requested company information, claiming that promissory note investments required confidentiality agreements and that detailed company information was only available to committed investors after initial investment. Dr. Rodriguez, promissory note companies maintain strict investor confidentiality to protect their business expansion plans from competitors. Chun insisted with apparent confidentiality requirements and competitive protection procedures. Detailed company information and financial documentation are provided after initial investment and confidentiality agreement execution. Chen also claimed that promissory note investments had limited availability and that delays in investment could result in missing opportunities for guaranteed high returns from established companies. Sandra felt suspicious about Chen's confidentiality claims and decided to research promissory note investments and verify the legitimacy of the claimed company backing before investing medical practice income. Sandra contacted the Securities and Exchange Commission to research promissory note regulations and learned that promissory notes were often used in investment fraud and that legitimate corporate debt was typically issued through registered securities offerings. Sandra also learned that promises of guaranteed high returns with principal protection were common characteristics of promissory note fraud and that legitimate debt investments involved disclosed risks and transparent company information. Sandra realized that Chen was likely operating a promissory note fraud by claiming guaranteed returns and company backing while avoiding transparency about actual investments and company verification. Sandra contacted Chen to request verifiable company information, but Chen claimed that regulatory compliance was complicated for promissory note investments and that his track record demonstrated investment legitimacy. Sandra reported the promissory note fraud to the SEC and her state's securities regulatory agency. She learned that promissory note scams often targeted high-income professionals with promises of safe, guaranteed returns from established companies. The authorities explained that legitimate corporate debt investments involved registered securities offerings with transparent company information and disclosed risks rather than private promissory notes claiming guaranteed returns. Sandra invested in legitimate corporate bonds and treasury securities through established financial institutions that provided transparent investment terms and regulatory protection rather than private promissory notes with unverifiable guarantees. The experience taught Sandra to research investment products through official regulatory sources and to be suspicious of private debt investments that claimed guaranteed returns while avoiding transparency about company backing. Sandra now educates other physicians about promissory note fraud and emphasizes the importance of investing in registered securities through established institutions rather than private debt instruments claiming guaranteed returns without transparent backing. Marcus, a 41-year-old small business owner, was seeking investment opportunities when he encountered an advisor that would test his understanding of legitimate investment structures and teach him valuable lessons about oil and gas investment fraud targeting entrepreneurs. The advisor offered tax-advantaged oil drilling investments with guaranteed returns and tax deductions. Marcus had successful business income and was interested in investment opportunities that could provide both returns and tax advantages, making him receptive to advisors claiming specialized knowledge of tax-advantaged investment structures. The advisor, Robert Martinez, from Energy Investment Partners, specialized in oil and gas investments and claimed to offer direct participation in drilling projects that provided immediate tax deductions and guaranteed production returns. Mr. Johnson, oil and gas drilling investments provide immediate tax deductions of 70 to 80% of your investment plus guaranteed returns from proven drilling locations, Martinez said with apparent energy investment expertise and tax advantage knowledge. These direct participation programs allow business owners to reduce current tax liability while participating in profitable energy production. Martinez explained that the oil drilling investments were located in proven production areas with guaranteed reserves and that investors received both immediate tax deductions and ongoing production income from successful wells. Mr. Johnson, our drilling locations are in proven oil fields with guaranteed reserves that ensure production income for investors. Martinez continued with apparent geological knowledge and production guarantee expertise. Independent geological surveys confirm oil presence and production capacity that provides reliable income streams for participating investors. Martinez offered Marcus investment opportunities ranging from $25,000 to $100,000 with promised tax deductions equal to 75% of investment amounts plus guaranteed production returns of 15 to 20% annually from oil sales. Marcus was interested in tax-advantaged investments but wanted to verify the drilling locations and understand the actual risks before investing business profits in oil and gas projects. I want to research the drilling locations and understand the risks before investing, Marcus explained to Martinez. Can you provide geological reports and financial information about previous drilling projects and their actual production results? Martinez became evasive when Marcus requested detailed information, claiming that oil and gas investments required confidentiality due to competitive drilling rights and that detailed geological information was proprietary to protect drilling locations. Mr. Johnson, oil and gas drilling locations require strict confidentiality to protect drilling rights from competitors who could interfere with our proven production sites. Martinez insisted with apparent competitive protection requirements and drilling rights security. Detailed geological information is provided after investment commitment to protect our exclusive access to profitable drilling opportunities. Martinez also claimed that oil investment opportunities had limited availability due to regulatory restrictions and that delays could result in missing tax deduction deadlines and guaranteed production opportunities. Marcus felt suspicious about Martinez's confidentiality claims and decided to research oil and gas investment regulations and verify the legitimacy of guaranteed production claims before investing business income. Marcus contacted the Securities and Exchange Commission to research oil and gas investment regulations and learned that legitimate energy investments involved registered securities offerings with disclosed risks and transparent geological information. Marcus also learned that guaranteed returns and production claims were prohibited in legitimate oil and gas investments because drilling always involved substantial risks and uncertain production outcomes. Marcus realized that Martinez was operating an oil and gas investment fraud by claiming guaranteed returns and tax advantages while avoiding regulatory transparency and legitimate investment documentation. Marcus contacted Martinez to request registered investment documentation, but Martinez claimed that direct participation oil investments operated under different regulations than traditional securities and didn't require standard registration. Marcus reported the oil and gas investment fraud to the SEC and his state's securities regulatory agency. He learned that energy investment fraud often targeted business owners with promises of tax advantages and guaranteed returns from drilling projects. The authorities explained that legitimate oil and gas investments involved registered offerings with disclosed risks and that guaranteed production returns were impossible due to the inherent uncertainties in drilling and energy production. Marcus invested in legitimate energy sector mutual funds and tax-advantaged retirement accounts that provided actual tax benefits and energy sector exposure without the risks of unregistered direct participation drilling investments. The experience taught Marcus to verify investment registration and be suspicious of guaranteed returns in inherently risky investments like oil and gas drilling that could not legitimately guarantee production outcomes. Marcus now educates other business owners about energy investment fraud and emphasizes the importance of investing in registered securities rather than direct participation programs claiming guaranteed returns and tax advantages. Jennifer, a 29-year-old software developer, was building her investment portfolio when she encountered an advisor that would test her knowledge of legitimate cryptocurrency investments and teach her valuable lessons about cryptocurrency investment fraud targeting tech professionals. The advisor claimed exclusive access to pre-launch cryptocurrency opportunities with guaranteed massive returns. Jennifer had experience with technology and cryptocurrency basics, but was interested in professional investment guidance for cryptocurrency investments that could provide significant growth potential during her early career wealth-building years. The advisor, Alex Thompson from Crypto Wealth Advisors, specialized in cryptocurrency investments and claimed access to exclusive pre-launch cryptocurrency opportunities not available to individual investors through standard trading platforms. Ms. Foster, Crypto Wealth Advisors provides exclusive access to pre-launch cryptocurrency opportunities that consistently generate 300 to 500% returns for early investors. Thompson said with apparent cryptocurrency expertise and exclusive opportunity access. These pre-launch investments are only available through specialized advisors who have relationships with cryptocurrency developers and initial coin offering sponsors. Thompson explained that pre-launch cryptocurrency investments allowed participation in new digital currencies before public trading and that early investors consistently achieved massive returns when currencies launched on public exchanges. Ms. Foster, pre-launch cryptocurrency investment is similar to getting shares of major companies before their IPOs, except cryptocurrency returns are typically much higher. Thompson continued with apparent pre-launch investment knowledge and return comparison expertise. Our clients consistently achieve 300 to 500% returns within 6 to 12 months when pre-launch currencies begin public trading. Thompson offered Jennifer opportunities to invest in 3 different pre-launch cryptocurrencies with guaranteed returns and promised that her investments would multiply dramatically when the currencies launched on major cryptocurrency exchanges. Jennifer was interested in cryptocurrency growth potential, but wanted to research the specific projects and verify Thompson's credentials before investing in pre-launch opportunities that promised extraordinary returns. I want to research these cryptocurrency projects and verify your credentials before investing, Jennifer explained to Thompson. Can you provide technical documentation about the cryptocurrency projects and your regulatory registration as an investment advisor? Thompson became evasive when Jennifer requested project documentation, claiming that pre-launch cryptocurrency investments required confidentiality agreements and that detailed technical information was only available to committed investors after investment. Ms. Foster, pre-launch cryptocurrency projects require strict confidentiality to prevent competitors from copying innovative technologies before official launch. Thompson insisted with apparent confidentiality requirements and competitive protection procedures. Technical documentation and project details are provided after initial investment and confidentiality agreement execution to protect revolutionary cryptocurrency innovations. Thompson also claimed that pre-launch cryptocurrency opportunities had extremely limited availability and that delays could result in missing investment opportunities that would never be available again. Jennifer felt suspicious about Thompson's confidentiality claims and decided to research cryptocurrency investment regulations and verify legitimate pre-launch investment opportunities before committing funds. Jennifer researched cryptocurrency investment regulations and learned that legitimate cryptocurrency investments involve transparent project documentation and that promises of guaranteed massive returns were typical characteristics of cryptocurrency fraud. Jennifer also discovered that Crypto Wealth Advisors was not registered as an investment advisor and that Thompson had no legitimate credentials for providing cryptocurrency investment advice or managing client investments. Jennifer realized that Thompson was operating a cryptocurrency investment fraud by claiming exclusive access to pre-launch opportunities while lacking proper registration and transparency about actual investment projects. Jennifer contacted Thompson to request verifiable project information, but Thompson claimed that cryptocurrency investments operated under different regulations than traditional securities and that registration requirements were still being developed. Jennifer reported the cryptocurrency investment fraud to the SEC, the Commodity Futures Trading Commission, and her state's securities regulatory agency. She learned that cryptocurrency fraud often targeted tech professionals with promises of exclusive access to revolutionary projects. The authorities explained that legitimate cryptocurrency investments involve transparent project documentation and regulatory compliance, and that guaranteed massive returns were impossible promises used to attract victims to fraudulent investment schemes. Jennifer invested in legitimate cryptocurrency through established exchanges and regulated investment products that provided actual cryptocurrency exposure without the risks of unregistered investment advisors claiming exclusive access to pre-launch opportunities. The experience taught Jennifer to verify investment advisor credentials and research cryptocurrency projects independently rather than trusting advisors claiming exclusive access to guaranteed high-return pre-launch opportunities. Jennifer now educates other software developers about cryptocurrency investment fraud and emphasizes the importance of using regulated platforms and verified investment advisors rather than trusting unregistered advisors claiming exclusive cryptocurrency opportunities. David, a 35-year-old pharmacist, was planning for his children's education when he encountered an advisor that would test his understanding of legitimate education planning and teach him valuable lessons about 529 plan fraud targeting parents saving for college expenses. The advisor claimed specialized 529 plans with guaranteed tuition coverage regardless of future cost increases. David wanted to ensure his 2 young children could attend college regardless of future tuition cost increases and was interested in education-saving strategies that could provide guaranteed coverage for rising education expenses. The advisor, Lisa Johnson from Education Planning Specialists, specialized in college savings and claimed access to enhanced 529 education savings plans that guaranteed full tuition coverage regardless of how much college costs increased over time. Mr. Williams, our enhanced 529 education plans guarantee full tuition coverage for your children regardless of future college cost increases, Johnson said with apparent education planning expertise and guaranteed coverage knowledge. These specialized plans provide tuition inflation protection that standard 529 plans cannot offer, ensuring that your children's education costs are completely covered. Johnson explained that the enhanced 529 plans were available through exclusive partnerships with education finance companies and provided guaranteed tuition benefits that protected families from unpredictable education cost inflation. Mr. Williams, standard 529 plans expose families to the risk that saved money won't cover future tuition costs due to education inflation. Johnson continued with apparent education cost risk knowledge and inflation protection expertise. Our enhanced 529 plans eliminate this risk by guaranteeing full tuition coverage through specialized education finance partnerships that provide inflation-proof education benefits. Johnson offered David enhanced 529 plans that would guarantee full four-year college tuition for both children regardless of which colleges they attended or how much tuition costs increased, requiring monthly contributions of $850 per child. David was interested in guaranteed education coverage but wanted to research enhanced 529 plans and verify Johnson's credentials before committing to substantial monthly contributions for specialized education savings programs. I want to research enhanced 529 plans and verify your credentials before enrolling, David explained to Johnson. Can you provide documentation about how these enhanced plans work and your regulatory registration as a financial advisor? Johnson became evasive when David requested documentation, claiming that enhanced 529 plans involve proprietary structures that required enrollment before detailed plan information could be disclosed due to competitive protection requirements. Mr. Williams, enhanced 529 plans involve proprietary education finance structures that require enrollment and plan participation before detailed information can be disclosed. Johnson insisted with apparent proprietary structure protection and competitive secrecy requirements. Standard 529 plan information is publicly available, but enhanced plans require participant commitment to access specialized features and guaranteed benefits. Johnson also claimed that enhanced 529 plan enrollment had limited availability and that delays could result in losing access to guaranteed tuition coverage before other families claimed available spots in the specialized program. David felt suspicious about Johnson's enrollment secrecy and decided to research 529 plan regulations and verify legitimate education savings options before enrolling in specialized programs claiming guaranteed benefits. David contacted his state's 529 plan administrator to research education savings options and learned that legitimate 529 plans were regulated government programs that provided transparent investment options without guaranteeing specific education cost coverage. David also learned that no enhanced 529 plans existed with guaranteed tuition coverage and that Johnson was not registered as an investment advisor authorized to sell 529 plan investments. David realized that Johnson was operating a 529 plan fraud by claiming non-existent enhanced features and guaranteed benefits while lacking proper credentials to sell legitimate education savings investments. David contacted Johnson to inform her about 529 plan regulations, but Johnson claimed that enhanced 529 plans operated through private partnerships rather than standard government programs and provided superior benefits for committed families. David reported the 529 plan fraud to his state's securities regulatory agency and the SEC. He learned that education savings fraud often targeted parents with promises of guaranteed college cost coverage through non-existent enhanced programs. The authorities explained that legitimate 529 plans were transparent government programs with disclosed investment options and that guaranteed tuition coverage was not available through any legitimate education savings program. David enrolled in his state's legitimate 529 plan that provided actual tax advantages and investment options for education savings without false guarantees about future tuition cost coverage. The experience taught David to research education savings through official state program administrators and to be suspicious of advisors claiming enhanced programs with guaranteed benefits not available through legitimate 529 plans. David now educates other parents about 529 plan fraud and emphasizes the importance of using official state 529 programs rather than trusting advisors claiming enhanced plans with guaranteed education cost coverage. Patricia, a 43-year-old human resources director, was approaching retirement when she encountered an advisor that would test her knowledge of legitimate retirement planning and teach her valuable lessons about variable annuity fraud targeting pre-retirees. The advisor pushed high-fee variable annuities while claiming they were necessary for retirement security. Patricia had substantial 401k savings and was interested in retirement income strategies that could provide predictable payments during retirement, making her receptive to advisors claiming expertise in retirement income planning and security. The advisor, Stephen Davis, from Retirement Security Solutions, specialized in retirement planning and immediately recommended variable annuities as essential retirement investments that provided guaranteed income and market growth protection. Ms. Thompson, variable annuities are essential for retirement security because they provide guaranteed income while protecting your savings from market volatility, Davis said with apparent retirement planning expertise and market protection knowledge. Without variable annuities, retirees face the risk of outliving their savings or losing money due to market downturns during retirement. Davis explained that variable annuities combined investment growth potential with guaranteed income benefits, and that Patricia needed to transfer her 401k savings into variable annuity contracts to ensure retirement security and income protection. Ms. Thompson, variable annuities provide the perfect combination of growth potential and income guarantees that no other retirement investment can offer. Davis continued with apparent unique benefit knowledge and retirement investment superiority claims. Rolling over your 401k into variable annuities ensures that you'll have guaranteed retirement income regardless of market conditions or how long you live. Davis recommended that Patricia invest her entire $280,000 401k balance in variable annuities with multiple insurance companies to diversify her guaranteed income sources and maximize retirement security through annuity protection. Patricia was interested in retirement income security but wanted to understand variable annuity costs and compare them with other retirement income options before transferring her entire 401k balance. I want to understand the costs and compare variable annuities with other retirement options, Patricia explained to Davis. Can you provide detailed fee information and explain how variable annuities compare with keeping investments in low-cost index funds? Davis became dismissive when Patricia asked about costs and alternatives, claiming that variable annuity fees were justified by guaranteed benefits and that other retirement investments couldn't provide the security and income protection that annuities offered. Ms. Thompson, variable annuity fees are minimal compared to the guaranteed benefits they provide, and no other investment offers the retirement security that annuities guarantee. Davis insisted with apparent cost justification knowledge and benefit superiority claims. Trying to manage retirement investments yourself or using low-cost funds exposes you to market risks that could destroy your retirement security. Davis also claimed that variable annuity enrollment had limited availability and that delays could result in losing access to guaranteed income benefits before insurance companies reduced annuity availability. Patricia felt pressured by Davis's security claims but decided to research variable annuities independently and compare costs with other retirement options before making major changes to her 401k investments. Patricia researched variable annuities and learned that they typically involved high fees that significantly reduced investment returns and that the guaranteed benefits often provided minimal actual protection for the costs involved. Patricia also learned that low-cost index funds typically provided better long-term returns for retirement savings and that systematic withdrawal strategies could provide retirement income without the high costs of variable annuities. Patricia realized that Davis was pushing variable annuities primarily because they generated high commissions for advisors rather than providing superior retirement benefits for investors. Patricia contacted Davis to inform him that she had decided against variable annuities, but Davis became aggressive and claimed that Patricia was making a dangerous mistake that would jeopardize her retirement security. Patricia reported the variable annuity sales pressure to her state's insurance regulatory agency and Securities Commission. She learned that variable annuity fraud often involved high-pressure sales tactics and misrepresentation of costs and benefits. The authorities explained that legitimate retirement planning involved transparent comparison of options and costs rather than high-pressure sales tactics claiming that expensive products were essential for retirement security. Patricia maintained her 401k investments in low-cost index funds and developed a retirement withdrawal strategy that provided income security without the high costs and complexity of variable annuities. The experience taught Patricia to research retirement products independently and to be suspicious of advisors claiming that expensive products were essential while avoiding transparent cost comparisons with alternatives. Patricia now educates other HR professionals about variable annuity sales pressure and emphasizes the importance of comparing costs and benefits of retirement options rather than accepting high-pressure claims about product necessity. Kevin, a 39-year-old dentist, was diversifying his investments when he encountered an advisor that would test his understanding of legitimate real estate investments and teach him valuable lessons about real estate investment fraud targeting high-income professionals. The advisor offered exclusive real estate syndications with guaranteed returns and tax benefits. Kevin had substantial income from his dental practice and was interested in real estate investments that could provide passive income and tax advantages while diversifying away from stock market investments. The advisor, Richard Wilson from Premier Real Estate Investments, specialized in real estate syndications and claimed access to exclusive property investments that provided guaranteed returns and significant tax benefits for high-income professionals. Dr. Martinez, real estate syndications provide guaranteed returns of 12 to 15% annually plus significant tax depreciation benefits that reduce your current tax liability, Wilson said with apparent real estate investment expertise and tax benefit knowledge. These exclusive property investments are only available to high-income professionals and provide passive income with complete property management included. Wilson explained that the real estate syndications involved commercial properties in growing markets with guaranteed tenant leases and professional management that ensured consistent rental income and property appreciation. Dr. Martinez, our syndicated properties include office buildings and retail centers in high-growth areas with guaranteed long-term tenant leases that provide predictable rental income. Wilson continued with apparent commercial property knowledge and tenant guarantee expertise. Professional property management ensures consistent cash flow and handles all investment management responsibilities for passive investors. Wilson offered Kevin opportunities to invest $50,000 to $200,000 in real estate syndications with guaranteed annual returns and promised immediate tax depreciation benefits that would reduce Kevin's current tax liability from his dental practice income. Kevin was interested in real estate investment opportunities, but wanted to research the specific properties and verify Wilson's credentials before investing substantial amounts in syndicated real estate projects. I want to research the specific properties and verify your credentials before investing, Kevin explained to Wilson. Can you provide property documentation, financial statements, and your registration information as a securities dealer? Wilson became evasive when Kevin requested detailed documentation, claiming that real estate syndications required investor confidentiality and that property information was only available to committed investors after initial investment. Dr. Martinez, real estate syndication properties require strict investor confidentiality to protect competitive acquisition strategies and tenant relationships. Wilson insisted with apparent confidentiality requirements and competitive protection procedures. Detailed property information and financial documentation are provided after initial investment commitment to protect our exclusive access to premium properties. Wilson also claimed that real estate syndication opportunities had limited availability due to accredited investor requirements, and that delays could result in missing guaranteed return opportunities. Kevin felt suspicious about Wilson's confidentiality claims and decided to research real estate investment regulations and verify legitimate syndication requirements before investing in exclusive properties. Kevin contacted the SEC to research real estate syndication regulations and learned that legitimate real estate syndications were registered securities offerings that provided transparent property information and disclosed investment risks. Kevin also learned that guaranteed returns were prohibited in legitimate real estate investments because property investments always involved market risks and uncertain income and appreciation outcomes. Kevin realized that Wilson was operating a real estate investment fraud by claiming guaranteed returns and exclusive access while avoiding regulatory transparency and legitimate investment documentation. Kevin contacted Wilson to request registered investment documentation, but Wilson claimed that real estate syndications operated under different regulations than traditional securities and provided private placement opportunities. Kevin reported the real estate investment fraud to the SEC and his state's securities regulatory agency. He learned that real estate investment fraud often targeted high-income professionals with promises of exclusive access and guaranteed returns from commercial properties. The authorities explained that legitimate real estate syndications involved registered securities offerings with transparent property information and disclosed risks rather than guaranteed returns and exclusive access claims. Kevin invested in legitimate real estate investment trusts and registered real estate syndications that provided actual real estate exposure with transparent management and regulatory oversight rather than private placements claiming guaranteed returns. The experience taught Kevin to verify real estate investment registration and be suspicious of guaranteed returns in real estate investments that inherently involved market risks and uncertain outcomes. Kevin now educates other healthcare professionals about real estate investment fraud and emphasizes the importance of investing in registered real estate securities rather than private placements claiming exclusive access and guaranteed returns. Michelle, a 36-year-old attorney, was managing her investment portfolio when she encountered an advisor that would test her knowledge of legitimate investment management and teach her valuable lessons about churning fraud targeting active investors. The advisor engaged in excessive trading that generated high fees while reducing investment performance. Michelle had accumulated substantial savings and was working with a financial advisor for professional investment management, but she began noticing frequent trading activity in her account that seemed excessive for her conservative investment goals. The advisor, James Rodriguez, from Active Portfolio Management, specialized in active trading strategies and claimed that frequent portfolio adjustments were necessary to maximize investment performance and protect against market volatility. Ms. Davis, Active Portfolio Management requires frequent trading to capitalize on market opportunities and protect your investments from downturns, Rodriguez said with apparent active management expertise and market timing knowledge. Passive investment strategies leave money on the table and expose portfolios to unnecessary market risks that active management can avoid. Rodriguez explained that his trading strategies involved sophisticated market analysis and timing that required regular portfolio adjustments to ensure optimal performance and risk management for Michelle's investment objectives. Ms. Davis, our proprietary market analysis identifies short-term opportunities and risks that require immediate portfolio adjustments to maximize returns and minimize losses. Rodriguez continued with apparent proprietary analysis knowledge and timing expertise. This active approach consistently outperforms passive strategies through superior market timing and risk management. Michelle began noticing that her portfolio generated substantial trading fees and that her investment performance was lagging behind simple index fund benchmarks despite Rodriguez's claims about superior active management results. Michelle wanted to understand why her actively managed portfolio was underperforming and generating such high trading costs compared to her expected investment outcomes. My portfolio seems to have a lot of trading activity and fees, but the performance is worse than simple index funds, Michelle explained to Rodriguez. Can you explain why active management is generating lower returns despite higher costs? Rodriguez became defensive when Michelle questioned the trading activity, claiming that short-term performance comparisons were misleading and that active management benefits became apparent over longer time periods through superior risk management. Ms. Davis, active management benefits are realized over longer time horizons, and short-term performance comparisons don't reflect the risk management and downside protection that active strategies provide. Rodriguez insisted with apparent long-term benefit knowledge and risk management superiority claims. The trading activity ensures that your portfolio is positioned optimally for changing market conditions. Rodriguez also claimed that questioning trading decisions could interfere with investment strategy execution and that Michelle should trust his professional expertise rather than focusing on short-term performance fluctuations. Michelle felt concerned about Rodriguez's dismissal of her performance questions and decided to research investment management practices and analyze her account activity independently. Michelle analyzed her account statements and discovered that Rodriguez was engaging in excessive trading that generated substantial commissions while consistently reducing her investment returns through high turnover and poor timing decisions. Michelle also researched churning practices and learned that excessive trading to generate fees was a form of investment fraud that violated fiduciary duties and regulatory requirements for investment advisors. Michelle realized that Rodriguez was engaging in churning fraud by conducting excessive trading primarily to generate fees rather than to benefit her investment performance and objectives. Michelle confronted Rodriguez about the churning activity, but Rodriguez claimed that active management necessarily involved higher trading activity and that performance would improve over time through superior strategy execution. Michelle reported the churning fraud to her state's securities regulatory agency and FINRA. She learned that churning was a serious violation of fiduciary duties that harmed investors through excessive fees and poor performance from overtrading. The authorities explained that legitimate investment management involved trading decisions based on client benefit rather than fee generation, and that excessive turnover without corresponding performance benefits indicated potential churning violations. Michelle transferred her investments to a fee-only advisor who provided transparent investment management with low-cost index fund strategies that delivered superior performance without excessive trading fees. The experience taught Michelle to monitor account activity and question trading decisions that generated high fees without corresponding performance benefits, and to work with advisors who prioritize client interests over fee generation. Michelle now educates other attorneys about churning fraud and emphasizes the importance of understanding investment costs and monitoring advisor trading activity to ensure that investment decisions benefit clients rather than generating advisor fees. Angela, a 47-year-old nurse practitioner, was seeking investment advice when she encountered an advisor that would test her knowledge of legitimate fee structures and teach her valuable lessons about fee manipulation fraud targeting healthcare professionals. The advisor charged hidden fees while claiming to provide low-cost investment management. Angela wanted professional investment management with transparent, reasonable fees and was attracted to advisors who claimed to provide low-cost investment services specifically designed for healthcare professionals with busy schedules. The advisor, Karen Phillips, from Healthcare Professional Investments, advertised low-cost investment management for medical professionals and claimed fee structures significantly lower than traditional investment advisors. Ms. Turner, Healthcare Professional Investments, provides low-cost investment management specifically for nurses and other medical professionals with management fees of only 0.5% annually. Phillips said with apparent low-cost expertise and healthcare professional specialization. This fee structure is much lower than traditional advisors who charge 1 to 2% annually, allowing healthcare workers to keep more of their investment returns. Phillips explained that the low-cost structure was possible through specialized technology and economies of scale from focusing exclusively on healthcare professional clients who had similar investment needs and patterns. Ms. Turner, our specialization in healthcare professional investments allows us to provide low-cost management through technology efficiency and economies of scale. Phillips continued with apparent efficiency knowledge and cost reduction expertise. By focusing on medical professionals, we can provide personalized service at lower costs than traditional advisors who serve diverse client bases. Phillips prepared an investment management agreement showing the 0.5% annual management fee and began managing Angela's $150,000 investment portfolio through what appeared to be a low-cost, technology-enhanced investment platform. However, Angela began noticing additional charges on her account statements, including trading fees, platform fees, administrative charges, and rebalancing costs that significantly increased her total investment expenses beyond the advertised management fee. Angela wanted to understand why her investment costs were much higher than the advertised 0.5% management fee and whether the additional charges were legitimate investment expenses. My investment costs are much higher than the 0.5% fee we discussed, Angela explained to Phillips. Can you explain all these additional charges and why my total costs are closer to 2% annually instead of the low-cost management we agreed on? Phillips became evasive when Angela questioned the additional fees, claiming that the 0.5% management fee was separate from necessary investment operation costs, and that the additional charges were standard industry fees required for investment management. Ms. Turner, the 0.5% management fee covers our advisory services, while operational costs like trading fees and platform charges are separate expenses required for investment management. Phillips insisted with apparent fee separation knowledge and operational cost requirements. These additional costs are industry standard and necessary for executing investment strategies and maintaining your portfolio. Phillips also claimed that questioning fee structures could interfere with investment management and that the total costs were still competitive compared to full-service investment advisors who provided comprehensive wealth management services. Angela felt deceived by Phillips's fee structure explanation and decided to research investment fee regulations and analyze her actual investment costs compared to advertised management fees. Angela researched investment advisor fee requirements and learned that advisors must disclose all fees clearly and that hidden fees or fee manipulation violated regulatory requirements for transparent cost disclosure. Angela also calculated that her total investment costs exceeded 2% annually when all fees were included, making Phillips's low-cost management significantly more expensive than many traditional advisors with transparent fee structures. Angela realized that Phillips was engaging in fee manipulation fraud by advertising low management fees while charging numerous additional fees that significantly increased total investment costs without clear disclosure. Angela confronted Phillips about the fee manipulation, but Phillips claimed that her fee structure was clearly explained in the investment management agreement and that Angela had agreed to all charges. Angela reported the fee manipulation fraud to her state's securities regulatory agency and filed a complaint with FINRA about deceptive fee practices targeting healthcare professionals. The authorities explained that legitimate investment management involved clear, comprehensive fee disclosure and that separating management fees from operational costs to create misleadingly low advertised rates violated transparency requirements. Angela transferred her investments to a truly low-cost advisor who provided transparent, all-inclusive fee structures that delivered the low-cost investment management she had originally sought. The experience taught Angela to carefully analyze total investment costs, including all fees and charges rather than focusing only on advertised management fees that might not include significant additional expenses. Angela now educates other healthcare professionals about fee manipulation fraud and emphasizes the importance of understanding total investment costs rather than trusting advisors who advertise low fees while charging numerous additional expenses. Robert, a 44-year-old business owner, was planning for retirement when he encountered an advisor that would test his understanding of legitimate insurance products and teach him valuable lessons about insurance investment fraud targeting entrepreneurs. The advisor pushed whole life insurance as an investment while misrepresenting costs and benefits. Robert had substantial business income and was interested in tax-advantaged retirement strategies that could provide both investment growth and insurance protection for his family while building wealth for retirement. The advisor, Daniel Thompson from Business Owner Financial Solutions, specialized in insurance-based investments and claimed that whole life insurance was the superior retirement strategy for business owners due to tax advantages and guaranteed growth. Mr. Garcia, whole life insurance provides tax-free retirement income and guaranteed growth that business owners cannot achieve through any other investment strategy, Thompson said with apparent insurance investment expertise and tax advantage knowledge. Wealthy business owners use whole life insurance as the foundation of their retirement planning because it provides benefits that traditional retirement accounts cannot match. Thompson explained that whole life insurance offered guaranteed annual returns, tax-free policy loans for retirement income, and permanent life insurance protection that made it superior to traditional retirement investments like 401k accounts. Mr. Garcia, whole life insurance guarantees annual returns regardless of market conditions while providing tax-free access to cash value through policy loans. Thompson continued with apparent guaranteed benefit knowledge and tax-free income expertise. This combination of guaranteed growth and tax-free retirement income makes whole life insurance the optimal strategy for successful business owners. Thompson recommended that Robert invest $5,000 monthly in whole life insurance policies that would build substantial cash value for retirement while providing $2 million in life insurance protection for his family. Robert was interested in tax-advantaged retirement strategies, but wanted to understand the costs and compare whole life insurance with other retirement investment options before committing to substantial monthly premiums. "I want to understand the costs and compare whole life insurance with other retirement options," Robert explained to Thompson. "Can you provide detailed information about insurance fees and how the returns compare with investing in index funds through retirement accounts?" Thompson became dismissive when Robert asked about costs and comparisons, claiming that whole life insurance provided unique benefits that couldn't be compared with simple investment strategies and that the guaranteed features justified any cost differences. Mr. Garcia, whole life insurance provides guaranteed benefits and permanent protection that investment accounts cannot offer, making cost comparisons inappropriate. Thompson insisted with apparent unique benefit knowledge and comparison inappropriateness claims. The guaranteed growth and tax-free income access are worth premium costs because they provide retirement security that market investments cannot guarantee. Thompson also claimed that business owners needed permanent life insurance protection and that whole life insurance was the only strategy that combined retirement savings with essential insurance coverage. Robert felt pressured by Thompson's benefit claims, but decided to research whole life insurance independently and analyze costs compared to other retirement and insurance strategies. Robert researched whole life insurance and learned that the policies involved high fees that significantly reduced investment returns and that term life insurance plus separate retirement investments typically provided superior outcomes for most investors. Robert also learned that guaranteed returns in whole life insurance were typically much lower than historical stock market returns and that policy loans reduced death benefits and could create tax complications. Robert realized that Thompson was pushing whole life insurance primarily because it generated high commissions rather than providing superior retirement benefits compared to lower-cost alternatives. Robert contacted Thompson to inform him about his research findings, but Thompson claimed that Robert was being influenced by biased information from investment companies that didn't understand insurance benefits. Robert reported the insurance investment fraud to his state's insurance regulatory agency and Securities Commission. He learned that whole life insurance sales often involved misrepresentation of costs and benefits to generate high commissions. The authorities explained that legitimate insurance and retirement planning involved transparent comparison of options and costs rather than high-pressure sales claiming that expensive products provided superior benefits without proper cost analysis. Robert implemented a retirement strategy using low-cost index funds and tax-advantaged accounts combined with term life insurance that provided superior investment returns and insurance protection at much lower total costs. The experience taught Robert to analyze total costs of financial products and to be suspicious of advisors claiming that expensive products provided superior benefits while avoiding transparent cost comparisons with alternatives. Robert now educates other business owners about insurance investment fraud and emphasizes the importance of comparing costs and benefits of financial products rather than accepting sales claims about product superiority without independent analysis. These stories show us that scammers are getting more sophisticated, but knowledge is our best defense. Trust your instincts, verify everything independently, and remember, legitimate businesses never pressure you to act immediately.